While American soldiers are stationed across the Middle East and US missiles are raining down on Iranian soil, something extraordinary is happening back in the shadows of the global economy. American companies, US-headquartered, US-listed, US-regulated corporations, have been quietly keeping Vladimir Putin's oil machine running. Not through some complicated dark web transaction, through normal business, through contracts, through staff, through technology transfers, and the US government, at multiple levels, let it happen. On February 28, 2026, the United States and Israel launched coordinated strikes on Iran. Supreme Leader Ali Khamenei was killed in the opening salvo. The Strait of Hormuz, the narrow choke point through which 1/5 of the world's oil supply flows every single day, was immediately closed by Iran's Revolutionary Guard. Brent crude exploded past $100 a barrel. Countries across Asia began rationing energy. Bangladesh closed universities early. Pakistan and the Philippines announced 4-day work weeks. The IMF warned that every 10% rise in oil prices adds nearly 0.5% to global inflation. In the middle of this energy catastrophe, a question almost nobody in the mainstream press is asking, who profits from $100 oil? The answer leads directly back to Russia, and to the American companies that never really left. When Russia invaded Ukraine in February 2022, the Western response was swift, at least on paper. Hundreds of companies announced their departure from the Russian market. McDonald's sold its restaurants. Halliburton exited. Baker Hughes walked away. The images of Western brands going dark were everywhere. It looked like economic isolation was real, but one company made a different calculation. SLB, formerly known as Schlumberger, headquartered in Houston, Texas, the single largest oilfield services company on the planet, stayed. And it didn't just stay. It expanded. SLB boasts that it helps Russian oil companies drill more for less money. As its competitors withdrew, SLB expanded in Russia, profiteering off Ukrainian suffering and playing a crucial role in Putin's most strategic industry. The company provides the proprietary technology and training that Russian engineers need for reservoir modeling and geological exploration. In plain terms, SLB is the brain trust of Russia's oil extraction operation. Without that expertise, Russian oil production slowly degrades. With it, the rubles keep flowing into Moscow's war chest. What happened when the US government found out? They gave SLB a special exemption. State Department officials called them guardrails. Critics called them something else. These so-called guardrails, however, have permitted the company to patent new technologies, train Russian engineers, and bolster oil production critical to Moscow's war chest. And here is where it gets darker. More than 50 members of Congress signed a letter calling on the US government to toughen sanctions on Russian oil and questioning an exception granted to US-based oil services company Schlumberger that allowed it to continue operating in the country. Representatives Lloyd Doggett and Jake Auchincloss put it bluntly. The exemption permitted Schlumberger to serve as an accomplice to Vladimir Putin. That was October 2024. SLB was still operating in Russia. Then in January 2025, new sanctions were announced that explicitly banned the provision of oilfield services in Russia. The deadline was February 27th. On February 11th, 2025, just 1 month after the United States introduced a new package of sanctions targeting Russia's oil sector, Schlumberger Technology Company, Russia, initiated a search for a contractor to manufacture a number of specialized components for its equipment based on proprietary designs. 1 week later, SLB and the Russian plant signed a technology transfer agreement. Legal experts who reviewed the situation were unambiguous. A partner at the firm Hughes Hubbard and Reed stated that the US sanctions risk exposure arising from SLB Russia's operations could not be higher at this point. So why is it still happening? American firms in Russia paid the country $1.2 billion in profit taxes in 2023. That is US corporations paying taxes directly to the Russian government in the middle of a war that Russia started. Think about what that means. Every dollar those companies earn in Russia, a portion flows directly to the Kremlin, funding the same war machine that Washington claims to be crippling. As of early 2025, 14,200 companies in Russia had owners from Western nations. The total revenue of Western-owned companies in Russia was still $203 billion in 2023, down from before the war, but not gone. Not even close to gone. And then there is BP. The British oil major, one of the 5 largest energy companies in the Western world, still controls a 19.75% stake in Rosneft through a UK subsidiary. Rosneft is Russia's largest oil company, the same Rosneft that was finally placed on the US sanctions list in October 2025. BP technically tried to exit after the invasion, but the stake remains. The dividends have flowed, the relationship has continued. UK-based Shell and BP have made $75 billion profit between them, while Ukraine has been mired in conflict. Since Russia invaded Ukraine, the 5 biggest Western oil majors, Shell, BP, Chevron, ExxonMobil, and Total Energies, have collectively booked profits of more than $250 billion. Some of that profit is a direct consequence of the price spike that Russia's war caused. Others are from assets and relationships that were never cleanly severed. The war created the very conditions that made Western energy companies extraordinarily wealthy, and that's not a coincidence. From February 24, 2025 to February 24, 2026, tankers sanctioned by the U.S. Treasury's Office for Foreign Assets Control carried $11,728,000 of oil, $11.7 billion, across 268 voyages. These are vessels that America has officially blacklisted. They are on the list. The list exists. And they moved 25.9 million tons of Russian oil anyway. The Dark Fleet, a shadow armada of over 600 aging tankers operating without Western insurance, without Western tracking, and increasingly without Western scrutiny, has become the circulatory system of a parallel oil economy. Russian crude, Iranian crude, Venezuelan crude, all moving outside the price cap framework that the G7 spent months designing. The enforcement shortfall is not accidental. It reflects a political calculation that enforcing sanctions rigorously might spike oil prices in ways that hurt Western consumers and Western economies more than it hurts Moscow. And here is the detail that should make you stop. From January 2024 to January 2025, the U.S. imported $192 million in oil products from Nayara Energy, a refiner backed by Rosneft Energy, a Russian company that is sanctioned by the U.S. The United States was buying refined oil products from a company with a sanctioned Russian entity behind it, American petrol stations, American supply chains, Rosneft fingerprints. Meanwhile, U.S. electronic components are turning up in places they have no business being. Electronic components manufactured by U.S. companies are still turning up in Russian fighter jets via intermediary trade routes. The chips, the semiconductors, the precision components. They move through Turkey, through the UAE, through Central Asia. They arrive in Russia relabeled and redocumented. They end up in weapons pointed at Ukrainian soldiers. SLB is the most visible case, but it is not the only one. Weatherford International, another U.S. oilfield services company, has been doing something that is almost impossible to explain in any framework other than deliberate profiteering. In the first half of this year, Weatherford's revenues from its Russian operations rose to 7% of the total $2.4 billion from 5% of the total for the first 6 months of 2024. Its cash and assets in Russia climbed from $233 million to $332 million. Weatherford had posted some 100 job openings for its Russian business since late February, when U.S. sanctions targeting, among other things, the oilfield services sector went into effect. Let that sink in. 100 job postings. For the Russia business, after the sanctions deadline. Higher drilling activity in Russia had offset lower activity in North America and Latin America. Russia is the cushion that keeps Weatherford's numbers looking healthy to Wall Street investors who have no idea where those revenues are actually coming from. This is the hidden architecture of the sanction regime's failure. Washington announces the policy, the Treasury writes the rules, the companies find the gaps, the lobbyists keep the gaps open, and the oil flows. Now zoom out to March 2026. The Strait of Hormuz is effectively closed. Iran's new supreme leader, Mojtaba Khamenei, the son of the man America just killed, has made it his first act of leadership to keep the strait shut as a tool of pressure. The strait remains almost entirely closed to Western-aligned shipping traffic. Iranian oil is still passing through, according to several marine intelligence trackers, underlining Tehran's control of it. The IEA has announced the largest emergency oil release in history, 400 million barrels. Those 400 million barrels only staunch the shortfall for 26 days. Saudi Aramco has warned of potentially catastrophic consequences for oil markets if flows don't resume. The IMF chief has stated that every 10% rise in oil prices is expected to add nearly 0.5% to global inflation. The first 100 hours of the U.S. military operation alone cost approximately $3.7 billion, mostly unbudgeted. The financial system is absorbing this in real time. And somewhere in Houston and in London and in The Hague, the executive suites of the Western oil majors are watching oil prices and having a very different reaction than most people. Because high oil prices are not a crisis for them. High oil prices are a quarterly earnings report upgrade. The people who control oil infrastructure in Russia, who profit from Russian energy revenues, who hold stakes in Rosneft, they are not suffering. They are watching their balance sheets improve as Iranian missiles close the strait and the world scrambles for every barrel of crude it can get. On October 22, 2025, the Trump administration did something that was framed as a dramatic escalation. The U.S. Department of the Treasury's Office of Foreign Assets Control imposed blocking sanctions on Russia's two largest oil companies, Rosneft and Loophole. This came after failed peace negotiations between Trump and Putin collapsed in Budapest. Treasury Secretary Scott Bessent declared, "Given President Putin's refusal to end this senseless war, Treasury is sanctioning Russia's two largest oil companies that fund the Kremlin's war machine." It sounded decisive, but read the fine print. China bought almost half the oil Russia exported in 2024. evading Washington's existing restrictions in the process, and new sanctions alone will do little to push China into significantly reducing its purchases. The mechanism to force China's hand exists, threatening to cut major Chinese buyers of Russian oil off from the US financial system, but Trump appears poised to remain lenient. Why? Because sanctioning Chinese parent companies means a trade war. It means the kind of economic confrontation that rattles US Treasury markets, drives up consumer prices, and creates exactly the inflation spiral that the Federal Reserve is already struggling to contain. So the sanctions are announced, the press conferences happen, and the oil moves. General licenses, legal carve-outs, and the sanctions framework give companies wind-down periods of months. Every wind-down period is a window for continued transactions. More than 75% of Russian oil exports now fall under US sanctions, but the enforcement infrastructure to make that meaningful simply does not exist at scale. The practical reality is this: oil payments from China were suspended or delayed over Chinese banks' concerns about secondary sanctions for a period. But that period ended when the political pressure shifted. The Chinese banks calculated their exposure and made a business decision. The US government let them make that decision. The United States is simultaneously prosecuting a military war against Iran at cost of billions per week, with oil prices spiking past $100 and potentially heading higher, while its corporate sector has been sustaining the very Russian oil revenues that fund the other side of this global confrontation. Russia supplies weapons and intelligence to Iranian-aligned forces. Iran threatens the strait that determines global oil prices. Higher oil prices benefit Russia's remaining export revenues, and American oilfield service companies profit from the Russian drilling activity that generates those revenues. This is not a conspiracy. It is a system where financial incentives override geopolitical declarations, where lobbied exemptions outlive political crises, where the announcement of a sanction and the enforcement of it are two entirely different things. The people at the center of this system did not design it in a back room. They simply exploited the permanent gap between what democratic governments say and what corporate entities do. Russia's sovereign wealth fund expected a number of US companies to return to Russia as early as the second quarter of 2025, and they had good reason to expect it. They had watched the pattern long enough to know that the pull of profit is more durable than the pull of principle. Meanwhile, US Treasury Secretary Scott Bessent claimed that Washington engineered a dollar shortage in Iran to send the Iranian rial into freefall and cause protests in Iran. The financial weapon was deployed against Iran's population. Thousands died in the protests that followed. The same financial architecture that sanctioned Iran's currency was simultaneously under-enforcing sanctions against Russia's oil sector. One empire gets the full financial war, the other gets exemptions, wind-down periods, and 100 job postings in Moscow. When the Strait of Hormuz closes, the countries that suffer first are not the United States or Russia or even Iran. They are Bangladesh closing its universities. They are Pakistan on a 4-day work week. They are Asian families paying 30% more for energy in a world where wages haven't moved. The IEA's emergency release of 400 million barrels buys 26 days. After that, the structural shortage remains, and the financial interests that benefit from that shortage remain in place, as they were before the war started. The Western sanctions regime against Russia has, by almost every analytical measure, failed to achieve its stated economic objective. The sanctions measures mean more than 75% of Russian oil exports fall under US sanctions on paper. In practice, Russia found buyers in China and India, built alternative shipping infrastructure, and watched its oil revenues surge in 2022 and remain elevated through 2023 and 2024, partly because the sanctions themselves spooked energy markets and drove up the price of the very commodity Russia was selling. The oil weapon, historically, has always been a double-edged blade. In 1973, the Arab oil embargo was meant to punish the US. It created the conditions for the petrodollar deal that made the dollar the global reserve currency for the next 50 years. Poorly designed sanctions have a tendency to accelerate the very outcomes they are designed to prevent. And the financial elite, in Moscow, in Houston, in London, are quite good at reading those outcomes in advance. The Strait of Hormuz crisis is not going to resolve in days. A slow, protracted war of attrition is probably Iran's intended outcome. Iranian leaders are calculating that their country is more willing to take casualties and absorb pain than either the United States or Gulf countries. Every week the strait remains closed is a week of oil prices elevated above $100. Every barrel above $100 is revenue for every oil producer on Earth, including Russia, including the Russian oil operations that US companies have been servicing and sustaining for 3 years of war. The broader picture is a global financial system under enormous stress. US debt interest payments have exceeded the defense budget. The Federal Reserve is watching inflation reignite from oil prices, even as it tries to cut rates to manage an economy slowing under tariff pressures. The dollar is being weaponized against Iran while simultaneously being undermined by the de-dollarization movements that US sanctions have accelerated in Russia, China, and the Gulf. And the companies at the center of all of this, and the oil majors, the service companies, the financial intermediaries, are reporting strong quarterly earnings. The Iran war is real. The casualties are real. The energy crisis is real. But the financial architecture underneath it, the one that keeps Russian oil flowing, that processes Iranian transactions through intermediary states, that turns war into profit, that architecture has not been touched by a single missile. It rarely is. History has a pattern for this. The Roman Empire's treasury funded the very border legions that would eventually turn on Rome. Medieval trading houses financed wars on both sides simultaneously, because the war itself was the most profitable market they had ever seen. The Bretton Woods system was designed to prevent exactly this kind of currency weaponization and financial fragmentation, and it took less than 3 decades before the contradictions overwhelmed it. What we are watching right now, across the Strait of Hormuz, across the Russian steppe, across the balance sheets of companies in Houston and London, is the same pattern. A financial empire trying to fight 2 proxy wars with one hand while its corporations fund the opposition with the other. The question is not whether this contradiction will eventually break something. The question is what breaks first and who position themselves for it.